Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving deep into Novo Nordisk, the pharmaceutical giant whose sheer dominance in the GLP-1 market is battling high competition and unprecedented operational and political challenges. We've synthesized a stack of sources to extract the must-know insights for you, our listener.
And the synthesized view is clear. The core investment argument for Novo Nordisk rests squarely on the massive, low-penetration global market opportunity and a formidable next-generation pipeline. However, this potential is currently discounted, and substantially, by material risks stemming from aggressive competition, acute U.S. pricing scrutiny, and critically the financial strain of a massive DKK 80+ billion capex commitment needed just to solidify their manufacturing moat.
That's the perfect setup. We have a foundational market opportunity facing significant, quantifiable short-term risk. What is the single, clear thesis statement that defines the risk-reward calculation for this deep dive?
Okay, boiled down, it's this. The core investment argument for Novo Nordisk rests on the massive, low-penetration global market opportunity and a formidable next-generation pipeline. But, and this is the crucial part, this potential is currently discounted by material risks stemming from aggressive competition, U.S. pricing scrutiny, and the financial strain of that massive DKK 80+ billion capex commitment.
Okay, let's unpack this pharmaceutical behemoth NVO. For a company that's now practically synonymous with weight loss products like Wegovy, well, Novo Nordisk actually has a century-long legacy anchored firmly in diabetes care. They are not some flash-in-the-pan company. They are really a structural pillar of the pharma industry.
That's absolutely right. Novo Nordisk is operating at a truly massive scale. And while their historical identity is tied to insulin and diabetes care, their core focus today has strategically expanded. We're looking at 4 key therapeutic areas: diabetes care, obesity care, rare disease, and crucially, an aggressive expansion into cardiovascular and emerging therapy areas. That includes conditions like MASH, chronic kidney disease or CKD, and cardiovascular disease, CVD.
And the scale is just huge, right?
Oh, yeah. To give you a sense of their reach, they touched 45.2 million people with diabetes and obesity care treatments in 2024 alone. 45 million.
Wow. And reaching that kind of global scale doesn't happen without constant internal refinement, especially when you're facing this level of demand and, frankly, competitive threat. Our sources highlight a major corporate transformation underway, which sounds like it wasn't really optional. It was aimed squarely at streamlining operations to reinvest for growth.
Yes, and this is where the strategy became, well, pretty ruthless. The company reorganized its R&D structure under the chief scientific officer, Martin Holst-Lange. They fundamentally merged research and development arms. The goal: sharper focus on fast advancement and the core therapy areas that really move the needle financially.
So trimming the fat, basically.
Exactly.
Yeah.
This reorganization resulted in the closure of several non-core projects. And these weren't small side projects. We're talking about eliminating their entire oncology program. Plus, certain platforms related to the SH that didn't fit the new model, and even the stem cell platform that had early development projects in Parkinson's and heart failure. They are eliminating redundancy and sharpening the focus entirely on what makes them money now and what they believe will make them a fortune in the next decade.
Speaking of money, let's get into the recent financial reality, because this restructuring, it came with a hefty one-time price tag, and that temporarily warped their reported growth numbers, which could easily mislead an investor who doesn't, do this kind of deep dive.
This is a critical point when you analyze their recent Q3 2025 results. They delivered a very healthy 15% sales growth at constant exchange rates, or CER, which adjusts for currency fluctuations, but their operating profit growth was only 10% at CER. So why the 5 percentage point difference?
The restructuring costs.
Exactly. Those costs acted like a massive financial anchor dragging down the reported figure. We are looking at one-off restructuring costs of approximately DKK 9 billion Danish kroner related to that company-wide transformation.
DKK 9 billion is a staggering expense. That's roughly $1.3 billion USD. Taken out in one hit. What does that expense tell us about the underlying business health?
It tells us the core GLP-1 business is incredibly robust, actually. Listen to this calculation from the sources. Had the company not incurred the DKK 9 billion in one-off costs, the operating profit growth would have actually been 21% at CER.
21%. Okay, that's a fundamentally different growth story than the 10% figure they reported.
It really is. So the lower reported growth, the 10% figure, is a temporary artifact of management cleaning house and investing heavily in future efficiency. This is why management narrowed the full year 2025 guidance down to 8-11% sales growth CER and only 4-7% operating profit growth CER. It reflects a temporary lower reported growth expectation for GLP-1s due to both market dynamics and this internal cost cleanup.
Okay, so if the underlying profitability is that strong, let's pivot to the growth thesis. The total addressable market, or TAM. This is the part of the story where the numbers become almost, well, unimaginable in scale.
They really are staggering, and this is the foundational argument for NVO's valuation.
Yeah.
The scale of the U.S. market opportunity alone arguably justifies the massive investment the company is making. We are talking about 115 million people with obesity in the United States.
115 million.
And another 35 million people with type 2 diabetes. That's nearly half the country needing some form of metabolic care, potentially.
And what's fascinating and I think really key to their strategy is the cross-pollination between these conditions. The patient overlap creates multiple entry points for their products, right? Increasing the probability of long-term patient retention and value capture.
Exactly. When you look at the patient overlap data in the U.S., the sources show 84 million people have T2D and obesity. Plus, their portfolio is increasingly relevant to about 17 million people with chronic kidney disease, CKD, and maybe 21 million with atherosclerotic cardiovascular disease, ASCVD. These are conditions now definitively linked to their GLP-1 portfolio's benefits. The market isn't just weight loss. It's treating a cascade of multi-systemic metabolic diseases.
And that's just the U.S. Let's zoom out to the global scale. The international runway must just dwarf the U.S. opportunity, right?
It does, significantly. Globally, the numbers are even bigger. More than 550 million people live with diabetes, and over 900 million people live with obesity. Critically, around 90% of global patients are outside the U.S.
90%.
Yeah, and this potential isn't some theoretical future state either. Look at Wegovy sales. They grew an astonishing 335% outside the U.S. in just the first half of 2025. That triple-digit international growth is pretty clear proof that the market is beginning to wake up globally.
But okay, despite these astronomical numbers, we are still talking about a massive unmet need and a very low penetration problem. If the need is so high, why isn't everyone who could benefit taking these drugs? What are the barriers?
This is the billion-dollar question that really defines NVO's current strategy. Their stated priority is explicitly unlocking the market because of this high unmet need and, frankly, low market penetration to date. We see that roughly 55 million people with obesity have some form of Wegovy coverage in the U.S. That sounds like a lot, but the barriers are still immense. Our sources, including KFF poll data, point to specific issues like affordability, even with insurance, and also injection hesitation.
Right, the PBM hurdles and the simple fact some people just don't like needles.
Exactly. These are the functional hurdles. Either the copay or deductible is too high because of the pharmacy benefit managers, or the patient simply avoids injections. This means that despite the huge TAM, only a fraction of those 55 million insured individuals currently have functional access or are willing to use the product.
Moving from the market penetration challenges to the structural components, let's look at governance. We mentioned the stability offered by the Novo Nordisk Foundation, acting as the controlling shareholder, allowing for a long-term view, which is great for big CapEx bets. But that long-term view, well, it can sometimes breed complacency, can it? Leading to maybe structural risk.
That's precisely why we are seeing what the sources describe as a forced governance overhaul. The board, likely prompted by the foundation, has recognized that the dynamic, high-growth obesity market, especially in North America, it requires specific modern expertise they perhaps currently lack.
Okay.
They are actively looking to fortify their competence, specifically noting a gap in U.S. operational experience and, interestingly, consumer competency. They realize their deep roots in European-style pharma might be hindering them in the more consumer-driven U.S. market, hence the search for directors with fast-moving consumer goods, or FMCG, experience.
FMCG, like CPG companies, that's a different world from prescription pharma.
Totally different. It sounds like they are trying to import expertise to handle an entirely new kind of market one that changes incredibly fast and is driven much more by patient awareness and choice, not just the doctor's prescription pad.
So how are analysts reacting to this? You've got a dominant company that is simultaneously restructuring its leadership, facing these massive external headwinds. How does that translate to the stock?
Well, the analyst's view, according to our sources, is actually leaning pretty bullish at current prices, despite all the volatility. The consensus seems to hold that the stock has fallen far below its peak pre-Wegovy hype levels. The implication is that investors might be over-panicked about competition from Lilly and others.
So they think the bad news is priced in.
Largely, yes. The sources specifically note that the stock is trading with a discounted PE ratio of just 13.3x. Furthermore, one analyst cited went so far as to call the stock's valuation definitely too low for such a dominant company, noting it is trading near a PEG ratio of 1.
Let's just break that PEG-1 ratio down quickly for our listeners. PEG, price earnings to growth. A ratio of 1 usually suggests the market is valuing the company as sort of a mature average growth company, which seems utterly disconnected from the reality of a company launching potentially the world's next massive blockbuster drug class, right?
Precisely. It suggests that the market has fully priced in a scenario of major competitive shrinkage or extreme future pricing pressure, or both. It's essentially discounting the enormous pipeline potential and that 21% underlying profit growth we talked about earlier. The analysts we reviewed seem to believe the stock has fallen too far, meaning the perceived risk is already perhaps more than fully reflected in the relatively low share price.
Okay, this brings us squarely to the battle lines. Despite that undervalued sentiment, the market is clearly discounting NVO for some very real reasons. Let's detail the competitive landscape and the significant risks to their dominance, starting with the competition. Who are the main threats?
Well, there are two major categories of threat here. First, the traditional well-funded pharmaceutical rival, Eli Lilly, LLY. No surprise there. Their drug, tirzepatide, marketed as Zepbound for obesity and Mounjaro for diabetes, is the clear main rival. And the competition is fierce. The data we reviewed shows NVO has recently lost approximately 9 percentage points of global market share in the overall GLP-1 segment, primarily to Lilly. That demonstrates a very immediate, very real threat.
9 points is significant share erosion. But then there's the other threat, the one that's maybe more insidious and harder to quantify or even police, the compounding pharmacies.
Absolutely. Compounding pharmacies present a massive competitive challenge and maybe more importantly, a significant IP violation and patient safety risk. Novo Nordisk's own market research, cited in our sources, estimates that well above 1 million patients in the U.S. are currently on compounded GLP-1s.
Over 1 million patients in non-approved versions.
That's the estimate. A staggering number of people taking cheaper, non-FDA-vetted versions of semaglutide or similar active ingredients. This represents an enormous leak in their potential market share and revenue.
Okay, now let's detail the risks facing the core investment thesis more specifically.
Yeah.
First, you mentioned that the pricing and IP threat.
Right. NVO is currently fighting aggressively on multiple fronts. There's the competitive pricing pressure, not just from Lilly directly, but also from government negotiations and payers pushing back. And then there's the IP violation from compounded drugs, which NVO publicly characterizes pretty strongly as intellectual theft. They consistently cite serious concerns over the presence of illicit foreign ingredients in these compounded versions, framing it primarily as a patient safety issue that requires them, in their words, to accelerate on all fronts.
Okay, so pricing pressure and IP theft. Second, what about the pipeline itself? Any risks lurking there, especially with the next generation combination therapies?
Yes, there is a notable flag here. The unproven amylin safety concern tied to the CagriSema trials. CagriSema combines semaglutide with an amylin analog. During the phase 3 trials, there were 2 reported incidents of suicide among the 3,008 patients. Now, a third-party committee concluded these events were not drug-related, which is important. However, the rate of these events was almost 5 times the expected background rate for this specific patient population.
5 times higher, even if not directly linked. That's got to raise eyebrows at the FDA.
It absolutely raises the risk threshold for FDA approval, especially when you consider that reasonably safe and effective alternatives like Wegovy and Zepbound already exist.
Yeah.
It adds a layer of uncertainty to that specific pipeline asset.
Then finally, the risk that seems almost like a political certainty now. Reduced pricing due to government regulation.
That's the future Medicare Fair Price, MFP risk, which is baked into the Inflation Reduction Act, or IRA. It's set to take effect starting January 2027. This risk essentially guarantees a future financial drag. It mandates price cuts in key channels, particularly Medicare. This future headwind is certainly contributing heavily to that discounted valuation we see today.
Okay, so Lilly, compounders, pricing pressure, IP theft, a potential pipeline safety question mark, and guaranteed Medicare price cuts down the road. That's a lot. Despite this multi-front war, NVO clearly has a considerable moat. How do they plan to defend their leadership position? What are the pillars of their defense?
Their defense really rests on 4 key pillars, based on our analysis. First, sheer market dominance. Despite the share loss to Lilly, they still held a dominant 56% global GLP-1 market share as of August 2025. That's still the majority by a good margin.
Okay, market share, one second.
Second, manufacturing scale. This is huge. The CEO confidently asserts, and the investments back it up, that NVO has built more capacity than anyone else globally for these drugs. This scale, backed by that enormous DKK 80+ billion in capex, is arguably their primary competitive weapon, especially against Lilly, who has also faced supply constraints. Being able to supply the market is critical.
Makes sense. Third pillar.
Third, solid patent protection and pipeline longevity. Continued innovation, specifically moving towards oral formulations like the Wegovy pill and Amycretin pill. This extends their product lifecycle and market relevance well beyond the initial patents. It mitigates the risk of the core semaglutide loss of exclusivity, or LOE, which starts hitting in the early 2030s. These new formulations could potentially extend protection out to 2034 or even beyond.
Right. Keep innovating to stay ahead. And the fourth pillar?
The fourth pillar is that foundation stability. The Novo Nordisk Foundation, as the controlling shareholder, allows them to make these massive long-term capital investments, like the DKK 80 billion plus manufacturing bet, without facing the kind of short-term shareholder pressure another company might. They can play the long game.
That manufacturing moat, built on that foundation stability, gives them the time needed for their pipeline war chest to deploy new weapons. Let's look at what is coming next, starting with the most immediate and probably commercially significant catalyst, the oral pill version of Wegovy.
Yes, the oral semaglutide, Wegovy pill, is seen as a potential game changer for market penetration, period. It addresses that injection hesitation barrier directly. Regulatory submissions for the 25 milligram dose, specifically for weight management, are already completed in both the US and the EU. And the timeline. The U.S. launch is expected as soon as Q1 of next year, so very near term, assuming the FDA gives the green light soon.
It's not just about the convenience factor of a pill, though. The efficacy data here is absolutely key to its potential success, right? Does it work as well as the injection?
That's the crucial finding. Clinical analysis, although indirect comparisons, has already shown that the oral formulation has comparable efficacy in weight loss, and also key cardiometabolic outcomes compared to the injectable Wegovy at the 2.4 milligram dose. This essentially removes that traditional patient trade-off. Patients might no longer have to choose between a convenient pill with lower efficacy or an injection with higher efficacy. They could potentially get both high efficacy and the convenience of a pill. This is really NVO's big answer to cracking that penetration gap wider open.
Okay, so the pill is near term. Looking further out, NVO is advancing their dual agonists, drugs designed to achieve superior efficacy, essentially trying to set an even higher bar for the entire drug class.
That's where cagrilintide comes in. This is that fixed-dose combination of semaglutide, their GLP-1, and cagrilintide, an amylin analog. The Phase 3 REDEFINE-1 trial results were pretty phenomenal, showing 22.7% average weight loss versus just 2.3% for placebo after 68 weeks.
22.7%. That's significantly higher than Wegovy alone.
It is. This aims for clear superiority over current monotherapy and provides NVO with a necessary potential head-to-head advantage against Lilly's dual agonist, tirzepatide, Zepbound-Mounjaro. They need something to compete directly on that dual action front.
But the one getting perhaps the most buzz recently, and maybe the company's best potential future weapon, is Amycretin. What makes that one special?
Amycretin looks like potentially the most promising next-generation asset in their pipeline right now. It's a unimolecular coagonist, meaning one molecule hits both the GLP-1 and the amylin receptors. The promising early data came from an injectable Phase 1b/2a trial. It showed an incredible 24.4% average weight loss over just 36 weeks with the highest tested dose, 20 milligram.
Wow, 24.4% in only 36 weeks. That is extremely fast and very deep weight reduction compared to current options.
Exactly. It generated a lot of excitement. And crucially, NVO isn't just betting on the injection. They're advancing both a subcutaneous injectable and an oral Amycretin into Phase 3 clinical development. Having a highly effective oral version of Amycretin would be a massive differentiator and ensures maximum market flexibility with what could be their next huge blockbuster asset.
So the internal R&D pipeline looks formidable, maybe even best in class. But Novo Nordisk is clearly not relying solely on organic growth to win this war. Their stated strategy involves aggressively leveraging external innovation through business development, BD, and M&A. They've said they need to treat hundreds of millions of people.
That's the management mandate we see in the sources.
Yeah.
They feel no pipeline is broad enough for that level of ambition. This strategic pursuit of outside assets was thrown into really sharp focus recently by the attempted acquisition of a company called Metsera, which created quite a bit of market drama. Metsera apparently held some highly differentiated next-gen GLP-1 related assets, and acquiring them represented either a key potential advantage for NVO or blocking a competitor from getting them.
Okay, so let's define Metzer's value a bit more. Why did NVO pursue them so aggressively, and why did it reportedly escalate into a bidding war?
Well, according to analyst sources covering the situation, Metzer's assets were seen as highly differentiated and very complementary to NVO's existing portfolio. They potentially offered advantages in areas like efficacy, maybe safety or tolerability profile, manufacturing scalability, and possibly less frequent dosing. These are all key long-term competitive factors. The sources confirm this pursuit did escalate into a significant bidding war, with Pfizer specifically mentioned as a key rival bidder. So NVO might have been trying to secure these assets for themselves and block a major competitor like Pfizer from getting access to these next-generation combination therapies.
Makes sense strategically. Yet, despite the clear strategic value and the heat of the bidding war, NVO ultimately walked away. They withdrew their bid. That decision speaks volumes about their internal financial discipline, doesn't it? Especially given the potential price tag.
It really does. NVO ultimately withdrew its bid, which analysts speculated could have reached $10 billion or more, a huge potential risk. They cited a prioritization of financial discipline and shareholder value as the reason. Specifically, they assessed the deal as carrying unacceptably high legal and regulatory risks.
Unacceptably high risk. So maybe issues with the assets themselves or the deal structure.
The sources didn't specify the exact nature of the risks, but the message was clear. It suggests that while NVO is definitely aggressive in pursuing M&A to bolster its pipeline, they won't pay any price, especially if the deal comes with significant legal or regulatory baggage. They clearly believe their internal pipeline, especially with Amycretin looking so strong, is robust enough to justify walking away from a potentially very high-risk deal. They effectively averted a massive potential financial and regulatory gamble.
Okay, let's pivot back to the commercial war zone, focusing specifically on how NVO is fighting that gray market compounding threat. The estimated 1 million plus patients taking non-vetted, non-branded drugs. This fight seemed to really define their messy, on-again, off-again relationship with the telehealth sector, particularly Hims and Hers.
Yes, the commercial fight against compounding really came to a head with the Hims and Hers partnership timeline. It's a fascinating case study in navigating this complex market. NVO initially made a deal to make branded Wegovy available directly on the Hims and Hers telehealth platform. This recognized the undeniable power and reach of telemedicine for accessing patients, especially cash pay patients. However, that collaboration went south very, very fast.
Right, detail the June 2025 termination. Why did NVO abruptly pull the plug on that relationship after only about a month?
The termination was very abrupt and very direct. NVO publicly cited concerns over Hims and Hers simultaneously selling and promoting knockoff compounded GLP-1 drugs on their platform. This created a direct, unavoidable conflict with NVO's core legal strategy and their public stance on patient safety regarding compounded drugs. They were essentially in partnership with a company that was, in their view, legitimizing the very compounded drug market NVO was spending millions fighting to shut down. It was untenable.
Which brings us back to the broader regulatory conflict and legal stance against compounding. The FDA loophole that allowed some compounding during the drug shortage was supposed to expire, wasn't it? Yet the compounder seemed to continue operating. That's the frustrating reality for NVO. Their market research, cited in the reports, shows that even though the main FDA compounding loophole expiration date, May 22, 2025, has passed, what they term unsafe and unlawful mass compounding has continued. So the regulatory action hasn't stopped the problem. As a result, the company's legal and public strategy centers almost entirely on protecting patient safety. They constantly warn about the risks of illicit foreign ingredients potentially being used in these compounded drugs. It's a powerful public health argument, even if it also very clearly serves to defend their intellectual property and market share.
But here's the twist. The sources also mentioned that renewal talks between NVO and Hims and Hers are actually ongoing. Why on earth would NVO bother talking again to a company that so publicly contradicted their core legal and safety strategy? This really underscores the immense, almost inescapable importance of telehealth platforms as a commercial channel, especially for reaching cash-paying consumers directly. NVO seems to recognize that if they completely withdraw from major platforms like Hims, They risk losing those potential customers entirely, not just to Lilly, but directly to the compounders selling through those same platforms. So they appear to be grappling with a very difficult balancing act. How do they maintain that critical digital access channel without inadvertently legitimizing the very compounding market that they're fighting so hard against? It's a real strategic dilemma.
This battle for patient access is obviously deeply intertwined with political and economic forces, especially in the U.S. This seems to be forcing NVO into some difficult trade-offs with governments regarding pricing. Let's start with the political context. Our sources reference the Trump Pride impact framing. What exactly does that refer to?
Yeah, that phrasing relates to the significant political pressure NVO faced, particularly during the Trump administration, but continuing beyond, over the stark price disparity of their drugs. The pricing for drugs like Ozempic and Wegovy in the U.S. was, and still is, dramatically higher than in other developed nations, like their home country Denmark or Canada. This huge gap triggered considerable political backlash and scrutiny. Our sources specifically noted the initiation of a Section 301 probe that's a type of trade investigation focused directly on this perceived unfair price disparity. This created a very high-stakes, politically charged negotiation environment for NVO, forcing them to engage on pricing to avoid potentially worse outcomes like tariffs or other trade restrictions.
Right. Okay, so they were under intense political heat. What did NVO manage to gain by addressing this pressure and ultimately agreeing to broader access, but at negotiated, likely lower prices? What was the positive side of the deal for them?
They seem to have played a pretty effective game of trade mitigation and access expansion, achieving some key wins. The positive outcome was really twofold, according to our analysis. First, and perhaps most significantly, the gain of Medicare Part D access for Wegovy for certain high-risk patients. This could potentially open up coverage for an estimated 30 million Medicare patients, dramatically expanding their insured payer base in the U.S. Second, as part of these broader trade discussions, they reportedly secured a crucial 3-year tariff exemption on specific materials or components needed for their manufacturing. Given their massive supply chain build-out, avoiding tariffs was likely a major financial win.
Okay, so expanded Medicare access and tariff relief. Big wins. But every negotiation involves give and take. What was the cost? What is the financial consequence of these mandated price cuts or rebates required to gain this expanded access?
There's a concrete projection for the financial downside. The combination of loss of exclusivity, LOE, hitting some older products in certain international markets, plus the pricing concessions necessary to gain that expanded Medicare and state-level Medicaid access in the U.S., well, it's expected to result in a tangible, negative, low single-digit impact on global sales growth, specifically in 2026.
A low single-digit drag on global growth. Okay, so that's the direct measure of the cost of that government negotiation access trade-off. They gain potential access to millions more patients via Medicare, but they have to accept a near-term revenue growth headwind as the price.
Exactly. It's a strategic compromise, sacrificing some price today for much broader volume and market penetration tomorrow, while also navigating intense political pressure.
Let's shift gears now to the operational backbone supporting all this growth. The kind of market expansion we've discussed demands truly colossal manufacturing capabilities and therefore capital investments. You mentioned that the manufacturing scale is a key moat. Let's quantify the financial cost of growth, the CapEx involved here.
The scale of investment is almost hard to comprehend. It really underscores the all-in nature of their strategy. To build and secure that manufacturing moat, the company's total cash flows just from investing activities, which covers everything from buying new machines to land acquisitions and massive factory construction, totaled an incredible DKK 128.9 billion in 2024 alone.
129 billion kroner. That's nearly $19 billion USD invested in 1 year.
Roughly, yes. An immense capital deployment. And within that, NVO is specifically investing more than DKK 80 billion, around 11-12 billion USD, into expanding their API active pharmaceutical ingredient production capacity. That includes building enormous new facilities, like the new 170,000 square meter multi-product facility going up in Kalundborg, Denmark. They are literally building the physical infrastructure of a global pharmaceutical empire right now.
And it's not just building from scratch. They're also complementing this huge organic expansion with strategic acquisitions to secure the entire supply chain, right? Specifically, the critical final step of fill-finish, putting the drug into the injector pens.
Yes, exactly. The Catalent acquisition was a really key strategic move to de-risk and secure the supply chain outside of just the raw API production. As part of a larger transaction involving their parent holding company, Novo Holdings, NVO itself acquired 3 former Catalent fill-finish sites. These are the specialized factories that handle the sterile filling of the injectable pens. This acquisition was seen as necessary to complement their massive internal supply chain expansion. It immediately brought in approximately 3,200 highly skilled manufacturing employees. The sources state this move ensures crucial future optionality and flexibility in that final, complex fill-finish process, a potential bottleneck they simply cannot afford to have disrupted by relying solely on third parties, especially with demand so high.
Makes sense. Control the whole chain. Finally, though, we have to address the inevitable flip side of this incredible growth, the ESG burden of success. Serving millions upon millions of new patients globally with manufactured products, often requiring refrigeration and complex logistics, it's creating a significant environmental toll. It's a tough paradox for a healthcare company.
It is the ultimate paradox of modern pharma success, isn't it? The soaring demand for their life-changing drugs resulted directly in a massive 24% increase in their total CO2 equivalent emissions year over year, just comparing the first 9 months of 2025 to the same period in 2024. The core difficulty, and it's a huge one, lies in Scope 3 emissions. That's the indirect emissions from their value chain suppliers, logistics, use of products, etc. For NVO, 96% of their total greenhouse gas emissions originate in this upstream and downstream value chain, Scope 3.
96% is Scope 3. Wow. That makes direct decarbonization incredibly challenging as it requires them to influence and control suppliers and logistics partners all around the globe.
Immensely challenging. You can build greener factories, sure, but controlling the carbon footprint of your thousands of global suppliers and the shipping networks is a whole different level of complexity.
So what are their stated commitments to try and address this daunting Scope 3 challenge? What are the targets?
NVO has set some ambitious targets. They're officially targeting a 33% reduction in Scope 3 GHG emissions by 2033, compared to a 2019 baseline. And their longer-term goal is achieving net zero across their value chain by 2045. Their stated overarching goal is to fundamentally decouple their ability to serve hundreds of millions more patients from their climate impact. It's a necessary goal from an ESG perspective, but achieving it will be an extremely ambitious undertaking given the sheer volume of product being produced, packaged, shipped, and used globally. Okay, so after drilling down through all these layers of the market, the competition, the pipeline, the operations, the politics, where does this deep dive leave us on the overall risk-reward spectrum for Novo Nordisk? The greatest immediate threats, the ones really pressuring the stock now, seem clearly to be the sustained significant pressure from that massive population using compounded GLP-1s estimated at over 1 million patients just in the U.S. It's a huge ongoing market leak. And second, the guaranteed financial impact of the Medicare pricing changes kicking in for 2026, which will create that low single-digit drag on global sales growth.
It's a known future headwind. Governance risk, well, it seems to be being proactively addressed with that board overhaul, but it's still a factor. And that discounted valuation, the PE, around 13.3x, tells us the market is highly, highly focused on these near-term risks right now.
Okay, that's the risk side, clear and present dangers. But on the reward side of the ledger, the thesis still looks incredibly robust, doesn't it? Supported by unmatched scale, that foundational stability from the foundation, and a pipeline that seems poised to consistently deliver potentially higher efficacy than even the current market leaders.
Absolutely. The reward case is powerful. It's driven fundamentally by that massive, still low penetration global market opportunity. It's catalyzed in the near term by the launch of the Oral Wegovy pill, potentially as soon as Q1 next year, which could significantly boost uptake. And it's bolstered longer term by those highly differentiated next-generation assets like CagriSema and especially Amycretin, which boast that potential for up to 24.4% weight loss, maybe even in an oral form eventually. When you factor in the company's unmatched manufacturing scale, a critical advantage right now, and the Novo Nordisk Foundation's structural stability allowing those huge long-term bets, well, they still hold a significant durable moat. And the innovation extends their effective patent protection potentially out towards 2034.
So putting it all together, the DKK $9 billion in obscured underlying growth, the near-term catalysts like the pill, weighed against the very real market risks from competition, compounders, and pricing pressure. What's the final objective investment verdict based on the sources we analyzed?
Given the market's current quite low valuation trading near that PEG 1 level, which seems to be pricing in substantial risk and potentially even shrinkage, rather than factoring in future pipeline growth. And considering the significant structural advantages NVO possesses in terms of dominant market share and manufacturing capacity, the risk-reward profile currently appears skewed to the upside. It suggests that the company might be substantially undervalued despite all these very real near-term headwinds. So the objective verdict, reflecting the analyst consensus we saw, leans towards outperform or potentially a strong buy, suggesting the stock has likely fallen too far relative to its long-term potential.
Okay, an outperform verdict despite the storm clouds. Here's the final provocative thought for you, our listener, to chew on as we wrap up. The integration of recent acquisitions like Akera Therapeutics for MA-FEACH, the liver disease, and the pursuit of assets like Amarosalsalpenibart for related kidney disorders, it demonstrates NVO's clear recognition that the future of obesity treatment is no longer just about simple weight loss. It's rapidly evolving into tackling the complex web of multisystemic comorbidities like NMASH, chronic kidney disease, and cardiovascular disease that are downstream consequences of obesity and diabetes. The big question for you is, will this strategic shift toward treating the complications of metabolic disease solidify NVO's leadership position long enough and create enough new value to successfully mitigate those imminent and unavoidable pricing pressures and eventual patent erosion risks? Risk defined, portfolio protected.